Take a look at the market right now. Trading in fine fettle, advanced decline is actually favoring the advancing. Pull up the Nifty for you, recovery, okay, 24,300 or thereabout is what it is. The small cap, mid cap is actually also in better shape right now. And banking will also come up, but generally, if you look at the environment, more and more voices are calling mid cap and small caps expensive now. Vinod Karki is now joining us to talk about markets and also how he's dissecting the numbers. Vinod, afternoon, good to see you. Vinod, you
Hi.
look at the earnings and everything with a magnifying glass. What is your verdict of the earnings quality so far? The delta between last quarter and this quarter, and the company which you are there in your coverage, how many have been higher than estimate? How many met and how many perform poorly?
Yeah, hi Ajay. So if you look at from actual versus expectation perspective, I think it is even Steven, more or less. No major surprises either sides, big time. That is one thing. If you talk about the actual growth in profit, the biggest drag on the profit is being driven by commodities. Oil and gas companies, metal, cement. So, but if you look at the undertone, the underlying businesses and their drivers for these commodity companies in general, the demand environment is not looking too bad overall. But what is being impacted is the realization broadly, which is really impacting the what you should say the profit, and that's dragging down overall profitability for the corporate India. Financials, on the other hand, is doing rather well. Industrials, if you see capital goods, utilities, energy, ex oil and gas, I mean, generally it's looking quite good. Auto, so it's a good number. IT also was not as bad as people expected, but still concerns remain about demand. So that's the thing. It's more or less in line, but no major excitement either.
So looking at the quality of earnings, this narrative that market is actually becoming fairly valued to expensive, uh, what's your rating on that? Or do you think that the valuation of the market actually in line with the kind of performance of the corporate India?
No, no. So Ajay, on the valuation, the verdict is there is no two ways about it, and we have been saying that look at any indicator, be it the spread between the earnings yield to bond yield or the market cap to GDP, which is closer to 150%. Just the PE itself, uh, north of 21, it was almost 22 some time ago. So I think there is no denying on the valuation that India's valuations are the richest only after US, in my view, currently on all most of these parameters. So what it is reflecting basically why, if you see calendar year till date, all the macro factors around India have been revised upwards or positively rather. So we had a GDP upgrade, 50 bips, and inflation got a little downgraded. So inflation expectations fell. Then fiscal deficit fell by 20 bips. What was 5.1 became 4.9. Current account we turned surplus. And the profit expansion continues, not very exciting, but it continues to expand. NPA is at a record low level. So all in all, the delta in data that we have seen from the start of this year have largely been revised positively, the macro factors, which I think, and we, if you remember, we started this year with a lot of election related uncertainty and monsoon related uncertainty. We were exiting the year with a massive El Nino effect, and now it has turned to La Nina, with monsoons now actually looking quite good, and the election uncertainty behind us, budget not showing any major populist or anything, any kind of thing which would have alarmed us on productive spend of the resources of government. So all in all, all this was being reflected in stock prices, which reached quite high levels. So that is the thing, though. I think we are on the verge of getting into some kind of a melt up in stock prices, especially in the mid space. So I think something was required to cool down stock prices, but that something should not be such a thing that it is completely, getting into some kind of a situation where you get into a bear market. I think that is what we believe. The recent shocks from Japan and US data both seem to have been exaggerated. So the two major drivers of this correction was this thought process that the yen carry trade is over, and the second is that the US is getting into recession. Both have got some very sharp reversals. The bond yield of US to Japanese bond yield that has expanded. US bond yields have now reached 4% versus 0.8 for Japan. And the yen has reversed some of that appreciation. While the US, if you see over the last 4-5 days, the ISM data and yesterday jobless data, I think all that is showing that the US economy continues to be resilient. So both these fears are getting back. I mean, it's showing that there was some exaggeration of fear in these two factors, which is reversing some of these fears.
What are your thoughts on the capital goods space, the way Cummins and ABB results and even the commentary came out? Are you getting a sense that, the kind of reported numbers and commentary actually will start justifying the high valuation in some of these places?
So across the board, I mean, the capital side of the economy, be it power or capital goods, their order book, I mean, that is showing that. And it is not just, see, we have been saying that if you look at post-COVID from 22 onwards, each print of the GDP was showing that it was led by gross fixed capital formation, which is basically the investment rate. And investment rate rising goes hand in hand with capital goods demands. And it is only building up. So I think but the second thing is about valuation. So market tends to overreact, and that's what you've seen in capital goods and industrials. The valuations are very high, basically. So, but to say that because of the high valuations, demand will be slow or something like that, that is not the correct assessment. So while the valuations will look very high, it is only reflecting that the growth is strong, basically. Right? So, we don't think you can get extraordinary returns from very high valuations, even if the underlying growth is good. That's
Vinod, which part of the market were you really positively surprised about earnings quality and hence are turning even more positive than earlier?
Yeah, so all these sectors, even energy, coal India, and so in general, if you see the market, where we think the valuations are quite reasonable and they are not reflecting record high valuations, I feel it is in banks, it is in some of these energy, metal, these kind of sectors. And we saw that the outlook for these sectors looked good. Most of these large banks also were quite reasonably, I mean, they did not disappoint significantly, even the PSU banks. In fact, State Bank was ahead of estimates, the largest bank.
Okay.
So I think these spaces are looking good, both from valuation and growth perspective.
Okay. Just one last word I want to understand on the healthcare side. Pharma and also hospitals, that's why I call it healthcare. There are a lot of healthcare related M&A which is likely to happen. My colleague Anurag just broke a story about Healthcare Global and CVC Capital stake is being eyed by 2 other large private equity companies. But what are your thoughts on the quality of earnings of this space, both large pharma and hospitals?
So increasingly, I find that pharma is not like, you take sector calls in most of the other sectors. It's no longer. I think it has become very stock specific. So certain companies are having issues. Certain companies are doing well. So so I think it has become more of a stock level kind of analysis, because each company is catering to different kind of products, different kind of dynamics, and all that. So, we have some positive views on certain companies, but it's not as if the whole sector is, what I should say, avoidable. Avoid or something like that. It is case to case basis, and there are certain companies where we find it positive compared to the valuation.
Right. All right, Vinod, we'll let you go on that one. Thanks so much for your time today.
If you like this video, then like, share and subscribe to ET Now.